I have a child who's 13 years old and she wants to go to the US, and it's ridiculously expensive. And she actually came back and said she wants to do undergrad. And when we looked at the numbers, it seems like we have to sort of spend anywhere between 60 to 80K USD per year. And the last thing you want to do is put your child through student loans, and they're indebted for life. So you want to sort of cover that. That's a lot of money. It's like a crore a year for 4 years, plus if they kind of do masters, then another. So therefore, what is the sort of investment that will then, give you that money over the period of time, and how quickly can you start investing in order to get you that sort of income?
Welcome to another insightful episode of the Mastermind Podcast, where today we dive into strategic wealth management and diversified investment. This discussion will explore how finance leaders can navigate market fluctuations by refining investment strategies and diversifying asset allocation across various asset classes to ensure sustainable and long term growth. It's a pleasure to have Jogendra Singh, President Finance with Hero Enterprises Limited, moderating this insightful session.
Thank you, Mania, and hello, everyone. As we navigate the increasingly complex financial landscape, wealth management has evolved from being a relatively static discipline to one that is dynamic, multifaceted, and strategic. Today's CFOs are not only financial gatekeepers, they're also key strategists who play a crucial role in ensuring the long-term financial health and wealth of organizations and individuals and stakeholders. We will explore the insights and strategies that leading CFOs are using to manage wealth with a focus on three key themes. One, strategies for effective wealth management. Two, building diversified investment portfolios. And three, the challenges and opportunities we face in the current global environment. Let's start by acknowledging that strategic wealth management today is no longer just about maximizing returns. It involves a comprehensive approach that includes optimizing taxes, leveraging emerging technologies, and seizing timely investment opportunities. The role of the CFO has expanded into these domains, requiring us to look at wealth management through multiple lenses. In an age where digital transformation is reshaping industries, technology plays a pivotal role in wealth management as well. From artificial intelligence to Gen AI to big data, today CFOs have access to many more tools and insights than ever before. The question is, how can we effectively harness these technologies to not only optimize current portfolios, but also to identify and capitalize on new investment opportunities? Another critical aspect is tax optimization. So this involves sophisticated planning to ensure the organizations and individuals are maximizing their returns while minimizing their tax burden. Our next focus is building diversified investment portfolios, which is a time-tested method of managing risk. But in today's fast-paced, highly interconnected global markets, diversification strategies need to be more sophisticated and responsive. Then there is also a question of right asset allocation in a world where market volatility is the new normal. How do we decide where to allocate resources to ensure that we are mitigating risks while still capitalizing on growth opportunities? Rebalancing investment portfolios is another critical challenge. Markets shift, economies fluctuate, and geopolitical events add layers of uncertainty, as we can see today. Given these complexities, how often should we be rebalancing our portfolios? What indicators should guide these decisions while balancing risks and returns? Finally, we will dive into the challenges and opportunities that are shaping the future of wealth management. Geopolitical situations, inflation, interest rate changes, supply chain disruptions, and political instability, all keeping in mind these are risks. And from these risks, how are we going to navigate very carefully? There are also some new factors, which come while making investment decisions like ESG. Investment and stakeholders are demanding more responsible investment practices. And as CFOs, we have a role to play in ensuring that these considerations are integrated into our financial strategies. With this background, I turn to my panel. And Asha, I just start this with you. In the current economic climate, what are the key factors that CFO should consider while identifying and seizing investment opportunities for long-term growth?
I guess one of the things that we always talk about for long term investment is really sort of setting out what the goals for the investment are. And it really depends on, which age and stage in life we're all in. And one of the things that, we need to start with ultimately is a 3 to 6 months, or even better, 6 to 12 months of emergency funds that are liquid and easily available. That should be something that's a non negotiable for everybody. In an ideal world. This is because we're so uncertain, right? Times are so uncertain. You don't know if your employment is going to, if you're an employee, if your employment is going to last, with organizational changes. Diversification of portfolio becomes really, really important, even from a spousal point of view. So, one of the things, because I lead women's networks, one of the things we always say is, one way to diversify your portfolio is to make sure both spouses are earning members, unless you have that much passive income that sort of covers it for you. And the reason we say that is, we've seen too many cases where either the spouse loses one. If there's one single earning member in the family, the spouse loses a job, the economic strata is impacted, and in some cases, very tragically, we've seen people impacted by critical chronic illnesses, as well as sort of sometimes even death. Especially during COVID, we saw quite a bit of that. So therefore, one way to diversify is to get more than one income stream. The second thing to think about really is around how we look at long-term goals. A term plan is another non-negotiable that we all know and talk about, right? So that's one. And the third is timing the market. Now, it really depends on everybody's risk and return philosophy. But if I were to talk about myself and my own goals, as a simple example, I have a child who's 13 years old and she wants to go to the US, and it's ridiculously expensive. And she actually came back and said she wants to do undergrad. And when we looked at the numbers, it seems like we have to sort of spend anywhere between 60 to 80K USD per year. And the last thing you want to do is put your child through student loans, and they're indebted for life. So you want to sort of cover that. That's a lot of money. It's like a crore a year for 4 years, plus if they kind of do masters, then another. So therefore, what is the sort of investment that will then, give you that money over the period of time, and how quickly can you start investing in order to get you that sort of income? The second one, of course, is retirement, right? So, in terms of retirement, it's not lump sum that we're talking about. We're talking about things like, monthly income and passive income. And therefore, I do love this concept of SIP. And I think the reason I love SIP is, one, it's doable, affordable. Every month you're paying yourself first before you spend. But the other thing is also you're timing the market. You're not sort of in the market looking at, when the market's going up and down and which stock is going up and down. As far as mutual funds are concerned, we have sort of a diversified portfolio. As far as we know, we can rebalance the mutual funds as well, right, in terms of equity and debt, and in terms of mid cap and large cap, etc. So somebody who doesn't have time and bandwidth, I would always say go for an MF, and then see what your goals are and when you're going to liquidate your MF. And also SIP to SWP for retirement. So systematic investment plans, put that in for some time, and then at whatever point you want to retire, retiring early is a new thing right now. Do you have systematic withdrawal plans for the SIPs that you set in place? Of course, you then think about other things like, real estate and, sort of FDs. FD I would consider as emergency, part of emergency fund. We shouldn't ideally be putting anything in FD for an investment lens. It's only a saving lens, if at all. And real estate is another one that's That's highly controversial at this point in time because the return is not as high as if you were to put it in the financial markets. So I would actually deprioritize real estate investments altogether, and say, go rental as much as you can until you retire, and by the time you retire, then invest in an apartment where you need to live in.
Yeah, good, Asha. You raised some very good points, from the personal investment point of view in terms of, long-term view, diversification, and even insurance, kind of things, that we should do. Uh, you also talked about, covering some very essential liabilities like children education, etc. And most importantly, we talked about finding the discipline of investment. I think that's also a very important point that you brought about. Coming to you, Vikas, what are the most effective tax optimization strategies CFOs can use to maximize wealth management for their organizations and on individual basis?
Great. No, so first of all, hello everyone. Thanks, Monia, for a kind introduction. And Jogendra ji, your opening remark was pretty comprehensive. I think I've also taken few cues, which I'm gonna delve further. But answering your specific question on tax, see, tax is a very, very important pillar when it comes to wealth management, whether it is an individual's life or it is in corporate tax planning or wealth management. And there are several strategies that one can explore depending on each individual situation, that what works well for you. I mean, if I talk about few important strategies, I one first and the foremost is the timing of the income or gains, or deferring of income or gains, which sometime can help you optimize your tax liabilities, which means your returns net of taxes is much higher. One example is, can you convert your short-term gains into long-term gains where the taxes are much lower? Or can you defer your incomes, aligning it to the losses or aligning it to the kind of downturn or where you have lesser income, so that your maximum tax rates are more effective? Even in case of corporates, we talk about aligning investments and accelerated depreciation and benefits, so that you can adjust your depreciation against the years in which the benefits are accruing and take benefit of lower tax impact on that. So that's one way to kind of match your incomes and losses, and accordingly time it to improve the effective tax rate on your investment. The second is tax loss harvesting, which is a very, very standard and well accepted practice. Uh, Sometime you want to hold on to an asset for a longer period, but due to volatility in the market, you may have seen a dip in the value of an asset. You can book those losses, reinvest into that asset, and adjust it against your income for that particular year. That is sometimes very, very effective, especially when you have windfall gains in a particular year. You can adjust it through tax loss harvesting. Another important factor which one should keep in mind, especially in corporates, and for if you're diversifying your assets into multiple jurisdiction, international tax planning. How do you look at for global organizations? You need to plan it very meticulously so that you pick up the favorable tax jurisdiction depending on your business case, so that you can take the maximum benefit of effective tax rate, as well as planning your transfer pricing into different jurisdiction within the permissible limits, and allocate profits so that your effective tax rate is remains within the permissible limit. Double taxation treaties is sometime an area which is quote unquote ignored, but I think one should pay a lot of focus when you're planning international jurisdiction from an investment perspective, to see how you can take benefit of double taxation treaties which are there with multiple jurisdiction. So that is another area. If I talk about what could be other areas, is from an individual perspective, it could be estate and succession planning. That is where you can optimize your taxes and optimize your returns. So these are few areas. Keeping tax in mind, you should plan so that you can optimize your returns post tax.
Yeah, I think you raised some very, very important points. No, we always say there are only two things permanent in in life. One is death, and two is
That's an
taxes.
fact.
Right. So really keeping taxes in mind while preparing any kind of strategy which has any kind of financial impact is absolutely paramount. And you brought out some very important points like timing and deferring of income and gains. I think that truly works very well. Tax loss harvesting is absolutely something. And I've seen people going through mergers, demergers, kind of areas also for this purpose. Transfer pricing and in offshore transactions, keeping track of double taxation treaties. I think that's absolutely very, very important point. Asha, coming back to you, we also talked about diversification of investment portfolio. So talk a little bit more about that. When building a diversified investment portfolio, what should be the approach in asset allocation across different classes, especially in times of market uncertainty?
So I guess when we talk about market uncertainty, instead of diversification, I always go back to timing the market. And like you absolutely rightly mentioned, timing the market is near impossible, right? You never know what you don't know. You can sort of predict, you can have a bullish outlook or you can have a bearish outlook. I've had friends who've talked about, when the election season was on in the country, people sort of said, okay, we're going to put away a large portfolio money. And then it was almost like if the BJP don't get so many seats, then obviously the market's going to go down and then I'm going to invest. So that's the bear case. So that takes a lot of one. I think a lot of interest in the stock markets and things like that, which is not really easy for professionals. So I go back to timing the market because even when you diversify, it makes a lot of sense to sort of play through the balanced fund allocations through mutual funds, the nifty large cap, mid cap, etc. So there are ways to diversify irrespective of market uncertainty. But wherever be the market, if we are timing the market through, sort of systemic investment, it aggregates over time, irrespective of the economic outlook. So that's one thing. The second thing, in terms of diversification, again, it goes back to risk tolerance of that particular individual as well. One is, of course, age and stage in life, goals, etc. But if you're not if you're very risk averse, then it makes a lot of sense to go into the bonds and things like that instead of going into the equity market. But if you are somebody who likes to take risk, then you do have organizations such as IPVs where they invest in startups, and you can sort of also allocate a certain portfolio to startups and then see what the sometimes the risk is very high, sometimes they can go bust, but then sometimes the return is also very high if they do really well as well. So diversification is such a personal preference pretty much. I also have had friends who've invested in crypto, and I've stayed entirely out of the crypto market simply because I've never really understood the fundamentals behind it. And same goes for derivatives and things like that. So for me, it's real estate, equity, mutual funds. Within mutual funds, it's balanced between large, middle. Because I'm a South Indian, there's a bit of gold, but that's less investment, more sort of personal preference. And real estate is mostly generational, and we've sort of invested in one apartment, which is ideally meant to be a retirement space, and now when we consider it, I think it is a bit too early. We should have done it a little bit more closer to retirement, because it is in a completely different city. Rental, it does not, sort of even cover the mortgage money. Although, back to the tax point of view, it also doesn't make a lot of sense to pay up your mortgage early because of the tax gain that you get, and how, the whole thing depreciates over time. So yeah, so these are sort of the things to bear in mind. It's completely very much a personal preference in terms of how you want to play the markets, and how risk averse you are in some of these scenarios.
Right, Asha. I mean, you brought out some good, balancing portfolio and looking at different kinds of investments that you do. I take the same question to you, Vikas. How can you mitigate the impact of market volatility on investment strategies while you look at growth opportunities as well? And maybe you can just talk a little bit more about real estate, because you come from that background.
No, no, I agree. I think seems like Asha has a view which is very entire real estate as an investment class. But I have a slightly different view, and hopefully I'll be able to convert Asha someday, start believing in real estate. But leaving that aside for the time being, see, market volatility is a constant challenge as far as wealth management is concerned. And while it's on the one side it's a challenge, but on the other side it's also an opportunity. While Asha was talking about uh, parking a lot of money into equity, depending on your risk appetite, and not doing some risky investments like cryptos and blah blah blah. But my only thing is, from a volatility perspective, the more you diversify your portfolio, the better it is, because it hedges between one particular asset class not performing well in a particular situation, but the other asset class may hold. Like when the financial assets doesn't perform well, in those situations, real estate typically performs well, right? So that is how you build that hedge, or for that matter, the gold performs well when your financial assets or equity markets are not doing well, because these are real assets. Gold and real estate, while it may not give you as high return as financial assets, but at the same time, these are real assets. It always gives you a consistent return over a longer period of time. And being an Indian, we've never seen real estate or gold going down, whereas financial investments also always have a up cycle and a down cycle. So diversification is important. And in fact, I will take it a little bit further when I talk about diversification. And I always say, in volatile markets, diversification is the first line of defense, right? Without diversification, you may end up making some crazy mistakes. Uh, uh, so when you talk about diversification, whether individual or corporate, you need to in fact go further down and talk about diversification at an industry level. So when I talk about I'm investing into equity, which sectors am I picking? Am I taking excessive bets in a particular industry, or am I spreading my equity investment into different industries? Like right now, tech stocks is the darling of the market, right? And BFSI or banking sector is not performing as well. But does that mean banking is not good? I will still continue to maintain my investment portfolio, having some exposure into banking, but at the same time, take some flavor of tech stocks, so that I can balance it out over a longer period of time. The other important factor over and above diversification in volatile market is rebalancing, and rebalancing from time to time, and it could be tactical, while it may go slightly against the concept of diversification. But when you are seeing a particular sector or a particular asset class not performing, tactically pulling out from that sector and going back into that sector as and when the sector start looking good, right? So that tactical rebalancing within the industry, within the asset class, is super critical. You need to keep a close watch so that you can rebalance it from time to time. You can also, from a corporate perspective, or even from an individual perspective, you can also look at hedging strategies where you can look at FNOs, you can look at inverse ETFs to protect the extreme downside movements and accordingly diversify your portfolio. In fact, these days, uh, a lot of MLDs are very, very popular from an individual perspective, right? Market linked debentures, which gives you an upside of the equity market, but also protects your downside in a worst case scenario. So one can explore that and have some portion of that in your portfolio, especially in current market situations, right? Where there are very diverse views in the market, where people are on the one side, people are saying markets are uh, very, very expensive, and we're going to see some corrections in the near term. But some people believe that it's not expensive, keeping in mind the growth story of India will continue to go up and up. So you can balance it out that ways. So the one important point which I agree with Asha. I think maintaining a good balance of cash and liquidity is super critical to manage volatility, right? And when markets are volatile, as I said, it's not only protecting the risk, it's also kind of taking the benefit of opportunities. We've seen that people got so cautious or careful and risk averse during COVID times, but it actually created an opportunity to go into the equity market, which yielded a very, very strong return over the next 3 years, right? So sitting on some portion of cash or liquidity is always good, whether an individual or a corporate, so that you can take benefit of those down cycles and take benefit of those opportunities and get better returns.
Yeah, because you brought out actually some very, very important points on diversification. And instead, I fully agree with you that diversification is the first line of defense in times of volatility. And of course, looking at the industry sector, going down to that level of diversification is and rebalancing from time to time. You can't be a passive investor today. You have to be an active investor, looking at what is the stakes are very high, and in volatile times, it's always good to create a method in the madness. So I think that is very, very important points that you brought about. Let's talk about some challenges and opportunities, Asha. How are the current economic and geopolitical developments influencing wealth management strategies, and what should we all be prepared for in the near future?
So, from an India point of view, the India story has been incredible, right? We've always seen robust economic growth, and folk in the US are like, "Where is 7% returns coming from?" And FTs give you 7% returns, right? But I think that also means that you have tremendous inflationary pressure. So, whatever you're investing in, the current value of the rupee is not going to be equivalent to the current value of the rupee, say 10 years. So, I guess we'll have to be very careful about our goal statements in terms of inflationary pressures impacting real value of money. That's one thing. The second thing is, the volatility of the Indian rupee also impacts, any global investments that we may want to make. So while in the US you have these seven large companies that are extremely exciting, like Nvidia story. I think I don't know how many of us have been able to get into the Nvidia story at all, but then Nvidia then crashed as well. That's another you know part of the puzzle. They blew it all up, and then it became a bubble. But the point is, can we invest in the US markets? Not really, not at this point in time, especially given the returns are, returns and the rupee fluctuating makes it difficult. The other bit is around regulatory challenges. So one of the things I've realized that people do in the US, which we can do from an HUF point of view, is what I've heard, haven't tried, is that a lot of wealth creation happens by setting up a corporate entity in the US. And then what people do is they then write off all of the expenses against that corporate entity. So even if you're a salaried person, that optionality we don't have, but we do have it from an HUF standpoint, where if you're married and partner and you can create a Hindu undivided family entity and then, get some tax benefits out of it. But our regulatory environment is not as tax savvy as, other countries are. The other bit is, we're all salaried employees, and I mean, at least I am. As a salaried employee, we end up paying more tax than if we were like a consultant. And again, the whole concept of being able to, carve out expenses, professional expenses against our consulting income, also really helps with tax. But then the regulatory environment becomes a problem. Geopolitical developments is another thing, right? So that's essentially why companies that have supply chain constraints with the US China issues, organizations that rely on, say, wherever there's conflict and that impacts our supply chain, be it, Russia, Ukraine, or, Israel, or whatever that is, then if we are investing in equity in organizations that have direct impact to supply chain from these countries, then that impacts your fundamentals of the organization as well. And back to Vikas's point on diversification of portfolio, I think, it's easier to then sort of think about just investing in the large cap Nifty 50 or whatever that is. That also, instead of looking at a sector, will help diversify a portfolio better, vis-a-vis, putting our eggs in one basket in terms of one organization, and then some random geopolitical tension impacting that company adversely as well. This includes everything from chips in Taiwan. Now they're saying Bangladesh, the conflict in Bangladesh will help India, but not necessarily. But does that mean we can sort of, trade in textile at this point? Not necessarily, right? So I guess back to what we need to consider, we need to think about the risk management in terms of economic volatility and geopolitical uncertainties. Therefore, diversification of investment and timing the market. But the piece around timing the market, I just want to come back on why it's so important. Timing the market is not timing the market when the stock market is low or high. The timing the market is aggregating the timing of your investments over a long period of time, which is not even a year. It could be 2 to 3 years, which then aggregates, sort of market fluctuations and uncertainties.
So that was a good definition of timing the market. When you say aggregating over a longer period of time, of course, that's what uh, are the words of wisdom, coming for investment strategies, for sure. Not looking at short term. Short term, you can take some opportunities, but then the view has to be long term. You can pick up some opportunities in short term. I think nothing wrong in that, and we should definitely try and do that, but not overtly focus. Not overly focus on that. So you are absolutely right. And global investing, I mean, today you can look at where, but India itself is giving you much more. It's only from diversification point of view that some part of you know your investment could be in US, for that matter. But largely it has to be India play, which story is much more intact and much more flourishing than anywhere else today. You also talked about risk management. Uh, and looking at some opportunities also coming out of the disruptions, like supply chain disruption. So the companies came out with China plus policy, plus one policy. So where exactly are we going? Is there some industry coming in India for semiconductor, chips, etc., that you're talking about again? So those are opportunities that we should be looking at. This is like in real estate also, we look at something from an organization's point of view, real estate organization point of view. Some piece of land I pick up, which I can use immediately, and some piece of land I pick up where I think maybe in about 10 years that market will develop, and at that point in time the prices would be high, so I'll just keep it, acquire it today and keep it in my land bank, kind of opportunity. So the same is true for individuals, as well. So coming to you, Vikas, there is another factor, where we talk about ESG. And ESG of late is becoming very important and popular. And we are all talking about responsible investing. especially from family offices or investment offices point of view. How, in your view, what are the consideration that you would like to give in the investment decision to ESG?
Yeah. So before I answer your specific question, Jogendra ji, I have a slightly different view on the diversification piece. While I truly believe in India's story and I'm very bullish about it, but when we are talking about diversification, I strongly feel that one should even look at diversifying beyond a particular jurisdiction, right? So I personally uh, track a lot US market. I've done some investments there. Like what returns the US tech stocks have given in the last 20 years, it's unprecedented, right? You just cannot miss that bus. Just cannot avoid to miss that bus. While yes, there are examples. Nvidia, we all are worried about what's going on because the AI, as we speak today, while everyone is so bullish about AI, everyone is cautious about whether it'll ever generate the ROI at the value or the price which we are putting it right now, right? So keeping that aside, coming back to the question which you asked me specifically on ESG, I I would like to start my response with, I think when you're talking about ESG, one thing which one need to keep in mind, what is good for the world is good for the business. You're not doing it for the society, you're doing it for yourself. You're not doing it for the society, but you're doing it for the business, right? That's the underlying thinking which you should have when you're talking about ESG. Yes, because it is shifting our gears as we are in a very, very different environment and we've already created a lot of damage to the environment. When we are shifting our gears to more responsible ways of doing business, protecting our environment, it may require initial investments, but the returns will be far, far higher over the longer period of time. So that is the underlying thing which one should keep in mind. So when we are talking about wealth management, how do we look at and wealth management as a concept, as both of you were talking about short term versus long term? Wealth management as a concept is long term, right? Because if we were talking about short term, it is more likely fall into speculation or trading category rather than wealth creation category. So aligning your ESG with long term financial goals is the way to go. ESG investing isn't just about social expectation, which I was mentioning. It is about aligning investment with the long term sustainability and financial growth, right? The companies with stronger ESG practices in place demonstrate better risk management, clearly are more resilient, have more resilient business models and stronger governance structures as compared to the other companies. So investing in those companies will definitely yield better return over the longer period of time. ESG is also important. You can do your risk management through ESG, right? The movement incorporating ESG helps you mitigate risks related to environmental regulation, social unrest, governance failures, and so on and so forth. So that is where ESG again becomes very, very important when you're making your investment decision. How do you give due weightage to some of these parameters when you're making your investment decision? For example, environmental risk like climate changes can directly impact or affect a particular industry, right? Like energy, we are talking about today, fossil fuel, there is a big threat on that industry itself, right? How do you de-risk that? Agriculture, I mean, if this global warming is real and this the way people are projecting is going to happen, there is a big question mark on our entire agriculture industry, right? So it is super, super critical to do the risk management on the back of ESG. Another important factor, while every risk also creates an opportunity, this also creates an opportunity for all of us. ESG opportunities are there where we are talking about renewables, we are talking about clean technology, we are talking about sustainable infrastructure. Looking at investment opportunities in these areas can actually yield much better returns over a longer period of time and can help you deliver good returns on your wealth. right? So I would leave the thought that ESG should be an important driver when you're making your investment decision, due weightage to be given on ESG, and you're not doing it for the society, but you're doing it for your own self or for your own business. That is how one should look at ESG. Uh, uh, I'll conclude my remark there.
Yeah, I think it's a very important, for us to really think about and talk about responsible investing or doing impact investing. Sometimes we, say, I remember some wonderful lines by one of the Hindi poets. He said, "अगर देश मर गया कहो फिर जिंदा कौन रहेगा, और जिंदा भी रह गया उसे फिर जिंदा कौन कहेगा."
Correct.
Right. So this was Maithili Sharan Gupta. Hmm? And in fact, I always say that, ESG, environmental issues, social issues are part of Indian ethos and fabric from time immemorial. We have always been saying Mata Bhume Putro Aham Prithivyaha, right? Or we say Sangachadvam, Samvadadvam, Samvo Manansi Jantam, or we say, Vasudhaiva Kutumbakam. All of these kind of issues, we have to really bring it together and think about it from the overall point of view that the business, what is the purpose? What is the higher purpose of business? It is the larger good. Hmm? And what you're doing is, what a business is primarily is absolutely a force for creating that good. So from that perspective, ESG is absolutely something that has to be a central, focus while making any investment decisions. Even though we all say that ESG is not yet profitable in that sense, but I would say that we should not really be looking at from profitability point of view at this point in time. Sometime when it reaches a scale, it will become profitable. Today, it has to be viewed from the point of view of existence. So it's an existential question. Profitability will come later. So I think this was wonderful. Looking ahead, if you just look at what in your view the most promising opportunities in wealth management that we should be focusing to drive future growth and diversification? Maybe one example without giving too much of an explanation. Maybe we can start, Asha.
Ladies first. Asha, you want to go first?
Oh, yeah, of course.
Actually, I think we've covered quite a bit, right, in terms of diversification and timing, and sort of even the what do you call that, outside of the country, where do we invest, etc. I think the only other thing I'd like to leave everyone with is, do think about a finance professional to support you with your investment, because that's quite the opportunity we leave. That's money left on the table. And the reason I say that is, when you work with a professional, you sort of are able to talk about your goals a little bit more, including, can you create a goal plan for a short term holiday for the next year? So really, really helpful to have somebody, and outsourcing that. The second is, again, a tax consultant as well. I mean, I think as finance professionals, we don't want to outsource a lot of it
Yeah.
because we think we know. But I do think, there are experts who can help us sort of restructure our tax, and also our finance portfolio. And the professionals come in with a better understanding. They are in it day in and day out, so they know what's going on in the market, etc. And I'd highly recommend one if you don't have one.
Vikas, what will be your views on this?
Yeah, so I think while we are talking about a very complex environment, volatile environment, uh, I think there is a huge opportunity in terms of integrating artificial intelligence and data analytics into your investment strategies, because these are two things which can help you analyze very large volume of data, literally on the fly, or on a real-time basis, which will help you enable better decision making and portfolio management. So that is one big opportunity I see clearly.